Ladies and gentlemen, good day and welcome to UGRO Capital Limited Q3 FY23 Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. From the management team, we have today Mr. Sachindra Nath, Vice Chairman and Managing Director, Mr. Anuj Pandey, Chief Risk Officer, Mr. Amit Mande, Chief Revenue Officer, Mr. Kishore Lodha, Chief Financial Officer, and Mr. Nirav Shah, Chief Strategy Officer and Head of Investor Relations. With that, I now hand the conference over to Mr. Sachindra Nath. Thank you, and over to you, sir.
Good evening to all participants. Thanks for spending time to listen to our results for this quarter. We have delivered as per our plans, which has been made public. But before that, for those who might be joining new, I would like to take you through the journey of UGRO in few words. UGRO was set up as India's first listed vehicle, which started fresh. We acquired a small listed NBFC in 2018 and raised approximately rupees 950 plus crore of equity capital from globally acclaimed private equity investors. We started our lending journey in Jan 2019, which was the first just post IL&FS crisis. In 3 years of our inception, we have seen through many other crises like DHFL, Yes Bank, COVID, and all other kind of other challenges for fintechs and NBFC. For all of us here and for our customers, this has been one of the most difficult times. Still, we have persevered and crossed the milestone of 5,000 crore of asset under management and 38,000 customers, maintaining the credit cost under control. This, among our peer set, is the most accelerated build-up of a lending business in this segment. This is the result of over-investing in our operating infrastructure, data-led analytical infrastructure, and distribution architecture, and we are seeing the results on asset growth and bottom line performance. Since our inception, we were and continue to be of the opinion that India's small business lending is at inflection point of explosion. We have seen a 1.5 decade of consumer financing growth, and now you would see a similar growth for small business financing. This is happening on the back of being able to underwrite an SME customer through the lens of fast emerging data stack underpinned by GST, digital banking, maturity of bureau coupled with deep data analytical prowess, which can underwrite the cash flow and not just the collateral. In addition to this, we believe that every small customer is different and they are not homogeneous. Therefore, you have to evaluate them with sectors and subsectors. We therefore built our credit scoring model, GROW Score, which uses the data of GST, banking and bureau, and our underwriters use our sector and subsector-based templated underwriting scorecard. We have one of the largest data analytics and technology teams for a company of our size and vintage. We always believe that data and technology will drive the MSME lending in India, and true to our belief, the entire ecosystem is now transitioning to an on-tap financing similar to what we have seen in consumer lending many years back. Our credit scoring model, which provides a decision within 60 minutes, is now well accepted across lenders and our co-lending partners. In last few calls, I did mention that India's NBFC lending model is transitioning from an on-balance sheet to an off-balance sheet lending, and UGRO is leading this transition as a leader. So on one side, we have the strength of serving the MSME through multiple products, and on the other side, we have our co-lending and liability partners. We have been investing heavily in teams and distribution network and taking all the cost upfront by creating a franchise which has the strength to now originate loan in excess of 600 crore per month. Banks lending to NBFC like us will take another shape in the form of co-lending, and here again we have seen the changes over the last many months. We continue to maintain a healthy mix of on-balance sheet and off-balance sheet risk by steering our co-lending and co-origination partnership with more than 10 of the large banks and multiple large NBFCs. As we speak, our off-book AUM ratio has reached 35%. which we had targeted to achieve by March 23. With respect to the on-balance sheet liabilities, UGRO is one of the few companies to have been backed by 65 plus lenders in a short span of time. Our total off-book volume was 724 crores compared to 590 crores in quarter two. The breakup of 720 crore was co-lending of rupees 273 crore, direct assignment of 108 crore, and this was supported by co-origination of rupees 343 crores. Income of co-lending and direct assignment is recognized upfront on the basis of discount rate. However, for the co-origination incomes, it accrues to us over life of loan as if the loans were on our balance sheet. Over our 4-year journey of precise execution and the process-driven approach, UGRO today has become a large-scale MSME lending platform comprising 5,000 crore of asset under management, 1,800 crore of quarterly disbursements, 100 branches, 38,000 customers, and more than 1,500 employees. While our numbers have been made available to you, I would share a few highlights. Momentum in growth of AUM and disbursement. Our total AUM increased to 5,095 crore from 4,370 crore in last quarter, up by 16% quarter on quarter. We have recorded the highest ever disbursement in Q3, which is stood at 1,874 crore for the quarter, which is 13% higher than the last quarter. In growth in terms of the total net income, our total income has increased to INR 108 crore for Q3 versus vis-a-vis 24% in Q2 23. As a percentage of on-book AUM, the net total income increased to 12.9% from 11.3% in last quarter. Our OPEX and cost to income ratio is stood at 63.9% in Q3 23 as compared to 62.7% in Q2 23, primarily on account of certain one-off expenses being recognized in the quarter. Adjusted for this one-off expenses, our cost to income ratio would have been around 60%. The employee costs month-on-month basis have been stable. The increase is only on account of bonus provisions, which we do normally in the last 2 quarters of the financial year. Our path to the higher ROA and ROE and profitability, the trend is very clear. Our PBT has increased to INR 22.2 crores in Q3 23, registering a 27% quarter-on-quarter growth, and our PAT for Q3 23 stood at 13.1 crore, registering a 149% quarter-on-quarter increase. Our cost of borrowing has seen no significant increase. We have a very well-diversified base of 65 plus lenders, including some of the largest banks and NBFC. While the cost of borrowing has remained at 10.5%, for most of the other players, it has increased by 100 basis points or more, while our cost has increased only by 20 basis points in last 2 quarters. And the last but not least, the disbursement in the loan lending as a service, or what we call the co-lending model. We have seen our total off-book portfolio increase to 1,775 crore, which is about 35% of our total AUM. We have started to see the result of the scale and liability franchise that we have created. Efficiency has started building out in our network, and same has started to reflect in our profitability on quarter-on-quarter basis. Despite demonstrating higher growth and improving profitability, the capital market seems to have not looked at the potential of our platform over the next 2 to 5 years. This might be because of our lower market cap, coupled with capital markets have been muted for lending businesses, and our differentiated lending model not fully propagated among institutional investors. We have proven our asset engine, its growth potential, our credit engine, and its ability to control credit costs. And now our focus for next year will be delivering profitability, which is comparable to any traditional or vintage lender. This, we believe, would put us in the bracket which is superior to banks and traditional NBFC. We have demonstrated that from the last year PBT of 20 crores, this year at 9 months itself, we have reached 50 crores. But now we would focus on doubling the bottom line over next financial year, while asset engine would continue to grow. It takes a lifetime to build financial institutions. We are toddlers vis-a-vis some of the other institutions in our industry. But with a deep sense of responsibility, we say that we are committed to build India's largest small business financing platform, serving the needs of the customer who otherwise do not get access to credit. And in that journey, we would build a financial profile with consistency which only few have ever achieved. Thank you for listening to us. We are here to answer any question which you may have. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Satish Kumar from Choice Equity Broking. Please go ahead.
Hi, thank you, sir, for taking.
Hello.
Yeah, give me a moment, sir. It looks like sir's line is muted. I'll just unmute it. Mr. Satish Kumar, please ask your question.
Yeah. So my question is about incremental disbursement. Over the last few quarters, we have seen incremental disbursement to the supply chain financing has been increased compared to our prime, unsecured and secured segments. So can you throw some light on this?
Sorry, your question is that you are seeing the growth in our disbursement, or is anything specific?
Incremental disbursement for supply chain financing segments has been increased over the last few quarters compared to other segments like prime secured and prime unsecured segments.
Yeah. So I give you a headline thinking what why it is happening, and Amit can take you through further. Look, as you would see our last 3-year journey, and you look at our distribution model and our risk profiling of our portfolio. We started with prime segment to begin with. We started with 8 location prime businesses supported by 500 plus intermediaries. And then over a period of time, we implemented multiple other channels. So then within our branch infrastructure, we opened roughly around 75 plus micro enterprises branches. Each of these branches take roughly around 18 months to get to a level of break even, and then it starts throwing assets from that point onward. We then establish our ecosystem channel, which is the machinery financing and supply chain financing, our partnership and alliances channel and digital, which will go live soon. So it is the evolution and very heavily investing into multiple distribution channels. And they are now, that's why the benefit is coming now. As time passes, each of our channel would grow. And also, you would see the yield profile of the company improving because most of our channels are secured and higher yielding segments. And also now we have established our data analytics and growth score far more because we have a track record of almost now 3 years to 2.5 years. So that is also helping us to grow all our channels. Amit, if you want to add something.
No, so Mr. Satish, thank you for the question and thank you, Sachin. Truly, and while you've covered that all our channels are now really coming up the curve and really being able to service all kinds of needs, supply chain is a very peculiar channel that we want to focus on because that really services the short-term need. And typically in these seasons, which are festive seasons, one would see that the supply chain demand is extremely high. We've been servicing this demand over last quarter and this quarter again, and so the disbursements in this channel has seen significant growth. However, this will also remain our key channel to service multiple focus sectors like green energy, like wash, like healthcare, and we will continue to focus on this channel, and in future as well, this will remain a significant contribution of our disbursements.
Thank you, sir. And so my next question is about the operating expenses. So our cost to income ratio is around over 60%. So and it's major share of our income. So when should we expect this to normalize going forward, sir?
So sir, the way, and I think so, we had expected capital market to be cognizant of the fact that you are seeing a company with a 3-year vintage. It started at ground zero. When we raised our capital, we had not a single person in the company, nor a single loan. Most of the time, what you are seeing in listed world is companies which operate as unlisted for at least 5 years, 7 years, 10 years. and get to a level of maturity and then come to the market. And that's why you pay them, X amount of premium. So we have established our business right from day one in the opening glare of a listed market and invested, very heavily in the OPEX. So these, our numbers are not comparable to most of our peer set, but obviously you don't have to worry too much about it because you have choices to make. As when you board a aircraft, the pilot says that you have many airlines to, go on. So you choose what provides you the best. But you also think in terms of what would, take you to your destination with safety. Vis-a-vis many of our peers, which actually in the initial first 5 years, bleed on the bottom line. So they burn capital and then come to a break-even point and, operating profit. We have been profitable from day one. And also we are competing head on to come to, a cost to income ratio, a return on asset and return on equity, which is equal to or better than most of our peer market. Our year beginning cost to income ratio was 72%. It is now at 60%. So all of our OPEX is now more or less complete. And what you are seeing is only the growth on the asset side. So with every passing quarter, this would continue to improve. I have said in my opening remarks that from a 20 crore of bottom line, we have now delivered 50 crore of PBT in the first 9 months. And our endeavor would be to double it for the next year. So, and I think if you look at our quarterly presentation, we have said that in 2025, we'll be at cost to income ratio of roughly around 45%, which is the best in the market.
Thank you, sir. That's all from my side.
Thank you. A reminder to our participants, if you wish to ask a question, you may enter star and 1 on your touchtone telephone. We'll take the next question from the line of Sheetal Gave from ULJK Financial Services. Please go ahead. Sheetal, could you please unmute your phone and go ahead with your question?
Hello? Hello?
Yes.
Yes, we can hear you well.
Yeah. So congratulations, sir, for great sets of numbers. Finally, you achieved 5,000 crores of AUM milestone, and we are sure that by 25 you can easily achieve 20,000 crores AUM milestone. So I have some couple of questions on the yield side. As you are focusing on the off-balance sheet portfolio around 50% by FY24. So currently the yield on portfolio, which is a total of on-book and off-book, is around 17.4%. So I just wanted to know, because the liability side is diversified, so that is the reason you can sustain your cost of borrowing. But I just wanted to know on the yield side, how is your view on a future that if you're focusing on the off-book, which is obviously it's a high yield business. So going forward, how you're looking on the yield side, yield on portfolio side?
So, sir, sorry, I think the off-book to on-book, yield on portfolio has no difference, right? So when you yield on portfolio is at what rate we lend to the customer, right?
Yes, correct.
That is independent of when we are lending to the customer, whether the asset is going in my balance sheet or is it going to a co-originating partner or it is going to a co-lending partner. Yield on the portfolio is yield on the portfolio, right?
Okay, so just wanted to know that what is your expectation going ahead by 24?
So, as I was answering the question from Choice Broking, that our prime business, which is technically a lower yielding business, is now, in terms of the percentage term, it is roughly around 50% of our monthly volumes. But our higher yielding business, micro enterprises, the machinery business, and few others, are now gradually growing. So we expect, and we are not making a prediction, but we expect that I said that we will endeavor to double our profitability, and that's a combination of OPEX remaining the flat, credit cost remaining same, stable and flat, and our portfolio yield gradually going up and AUM going up would double the profitability. So I think so it's very difficult sitting here to predict how in percentage term what would be the yield increase on the portfolio, but definitely there'll be an inching up which will happen now.
Okay. Great. And the second question is on NPA side. So now obviously it's only 2-3 years of operations of UGRO. So currently it's like very nominal GNP and NNPA. So now the company is focusing on the AUM growth part. So going forward, because the majority of AUM is the secure, right? So how going forward you are expecting that the NNPA will be by 25?
Anuj, you want to take this?
Yes, I will take that. So, the overall portfolio quality is a function of the overall portfolio mix as well as in individual business lines, what is the expected GNPA. So with our statistical scoring models now quite stable, we are in a position to somewhat predict of how the portfolio will behave. As you would, and we have been reiterating this in previous calls as well. The endeavor is to have a healthy balance in the portfolio with secured book overall to be around 70% and unsecured book to be around 30%. And the projected, if you see our 5-year plan, the projected gross NPAs are not likely to be over 2%. And the way things are, and we have seen the early warning signals and early indicators of the portfolio, we think we would remain within that.
Okay, fine. And on the last one is on the capital raise. Like in the last 3 years, you raised around 30 billion through equities and debt. So going forward, because now the UGRO is focusing on off-book AUM. So now, is there any plan in 1 year down the line for any capital raise?
So we have already, disclosed at the beginning of the year itself that by end of the quarter, which is the fourth quarter of this year, or the next quarter of, first quarter of next financial year, we would be doing the capital raise. Its form, shape, and size is not yet defined. But at the speed and the growth rate which we would definitely be raising capital.
Okay, fine. Thank you so much, sir.
Thank you. We'll take a next question from the line of Ankur Kumar from Alpha Capital. Please go ahead.
Hello, sir. Congrats for a good set of numbers. Sir, you talked about safety and in the line of that aeroplane. So I just wanted to ask, because we have grown to 5,000 crore in about 3.5 to 4 years, and we have good targets for coming 2 years also. So, but this fast growing is generally considered not so safe in a financial institution, as in from the capital markets perspective. So how do you think we are going to manage in terms of both growth as well as managing the NPAs?
So the answer to this is that, sir, if you compare us with 10 other NBFCs, which are in micro enterprises segment, there is not a single one started with a total capital at the day one of 950 odd crore. So you have recently seen a 5-star going IPO. 5-star to reach at the scale where they are have taken 15 years. But it is not because either the capacity was a problem, or the market opportunity was a problem, or a speed was a problem. It is because they started with only 25 crore of capital, and to get to the base of capital where we are, it takes roughly around 10 years. So the fast growth is not a function because we are disbursing money, recklessly. So right from our day one, the login to disbursement rate for UGRO has been stable at 30%. For a 400 crore worth of loan, we originate 1,600 crore every month. It is a function of the capacity which we build over first 3 years, and that is what is setting the volume, and that's what maintaining the credit quality. So this business at the end of 2020 had only 150 people, 8 locations. At the end of 2022, it had roughly around 1,500 people, 100 locations, 150 people in technology, 40 plus people in data analytics. So our growth, and we are not chasing growth. Actually, our installed capacity versus what we are delivering, we already have a gap of 30-40%. So we are not chasing growth. Growth is coming because all our verticals have been deeply established with both people, technology, and credit processes. There will be definitely a point of inflection after which the company would grow at a 15-20% per annum basis. But till that time, the base effect of our infrastructure will deliver the growth.
Sure, that's great to know, sir. And sir, in terms of tax rate, this quarter we had high tax rate. So can you explain why and what is our expectation for the tax rate in the coming years?
You sure you want to take that?
So it is largely because of two factors. One is that since we are into MAT, we are still into the old regime, so which is higher compared to the normal tax rate. And also during the merger of Asia Pragati, we have inherited some carry forward losses where we have created deferred tax assets, some of which has got lapsed during the period, and hence we had to reverse those losses. So H1 we have taken a hit of around 7.2 crores, and we have incrementally made provision of around 4 crore during this quarter. So cumulatively in YTD December we have made additional provision of around 11.3 crore on deferred tax asset which was created earlier and now require reversal. Otherwise we would have been, if you remove that, then we would have been a normal stable regime of 30%, which is in line with the old regime of taxation. We are into MAT, hence we have not migrated into the new tax regime.
So how much of this deferred tax asset is still pending, sir?
So deferred tax asset is pending in the books is roughly around 17 crores over next, which is available for over next 2 to 3 years, and one would be available till next 7th year. Part of it we should be able to utilize, but a part we may have to take a reversal in coming quarters.
Sure. And sir, one question, in terms of coming 12 months, what are the risks that we see in terms of achieving our guidance, in terms of, as you were saying, doubling of the profit before tax and growing AUM that fast? So what are the risks that we see in the business?
So we operate in the customers turnover customer segment in the loan ranges of 10 lakh to maximum 3 crore, unsecured loan only maximum of 25 lakh segment. Generally, all of this noise about inflation, economic slowdown, Ukraine war, and all of that, we believe that to a very large extent, the micro enterprise segment is microeconomics. And also, we are not seeing a major economic slowdown to happen in India, which can cascade to the bottom of the pyramid. So generally, from the customer segment in which we operate, we are seeing very healthy growth for all our segments of the market. Having said that, as a financial institution and as a lending institution, increased rate scenario is obviously of a concern, because if our borrowing rates consistently keep increasing, then obviously that's a problem, because our customers finally cannot afford a very high cost because they have a very limited margin. But good thing or a good story about it is that we are now seeing the rate hikes to taper down, and we are only hoping that only 1 or 2 hikes to happen more. Second, I think so that generally the liquidity in the banking system has reduced because the credit demand has been extremely high. And obviously, as you know, we are largely dependent upon banks and also the capital market, public market, DFIs. But we are not growing by 25,000 crore a year. Our growth rate and number of diversified lenders, we think that is also not a big challenge. But that's also, continue to be a risk for the broader market.
Sure, sir. And sir, in terms of secured book, you're saying 70% book is secured. What is our LTV on that book?
Anuj, take that.
So it is divided between secured by property and secured by machinery primarily. So in secured by property, our average LTVs are around 55%. And on secured by machinery, our average LTV would be around 65 to 70%.
Sure, sir. And sir, last question would be, as in you talked about capital markets not appreciating our journey so far, but we have as in we have PEs on the board. So what is exactly can you, as in you would have talked to some of the institutions, so what is exactly that they seem to be thinking that we are missing because of which capital market is not appreciating us?
So as I said that, there are multiple reasons and, it's very difficult to specify. But first and foremost reason that we emerged just prior to IL&FS crisis, and capital market has seen multiple financial institutions to be under trouble, BHFL, yes, banks, so on and so forth. Then capital markets saw a massive wave of COVID which affected the lenders generally. So I think those two elements itself, while there was a broader rally in all other sectors, banking and NBFCs had not seen a rally. Now we are seeing a little bit of a rally happening only for top tier private sector banks. But there are also many number of banks and NBFCs which are, which what we call the traditional and legacy, which are also available to public market at a very reasonable price. I think so, look at this way. If we would have done an IPO, primary IPO now, or 2 years down the line, you guys would have, paid a value which would be 4-5x higher than what we are today. But we are okay with that. But eventually, our model is superiority on a lower capital base, being able to, an entity which is being able to generate much higher ROE would get appreciated. So, no businesses which are superior to their peer set can remain out of mainline radar for a very long period of time. And we are making a conscious effort for broader market to understand us better.
Sure, sir. And in terms of closest listed competitor, would we call 5-Star as our closest competitor or?
No, sir. I think so that, I think we are in the domain of fintech and, fintech credit platforms are yet to be listed. Paytm was the last and Bank Bazaar was the last, fintech which got listed, but both of them were non-credit businesses. And both of them, went to the market on a metrics of listing, which at least I don't understand. So if you look at our asset profile and our business profile, we don't have a direct peer set. So our prime business compete with the banks, our micro enterprises business compete with 5-Star, with Star Veritas. Our supply chain finance business, compete with global fintechs which are in supply chain. Our CG business compete with Electronica and others. Our P&A business, is similar to that, would be a Match Financial, which is enlisted. And when we launch our digital channel, that will be a completely fintech platform. So I think so we are creating a category of India's largest small business financing platform driven by data and tech. So, and we hope that others would also follow it. So it's very difficult to say this is our listed nearest peer. But purely from a valuation perspective, while we are big, broad, diversified, so it's monoline business are, where they are. So, obviously investors have to make their choice.
Sure, sir. Thank you and all the best.
Thank you. Our next question is from the line of Akash Jain from Ascon Global Services Limited. Please go ahead.
Congratulations, sir, on a very good set of numbers. My question pertains to the growth for FY24. Like AUM target, we have around 7,000 crores. So predominantly, we have shortlisted around 8 to 9 sectors and exposure to those accounts which have a credit history. So are we looking to broaden our sectoral outlook beyond those 9 sectors?
Anuj?
So when we had selected these 8 sectors and then we added a 9th sector called micro when we started the business, they were actually pretty large sectors in themselves and contributed about 45 to 50% of total SME GDP. And the way we are seeing traction overall and the buoyancy. If you recall, our 8 sectors, 3 are quite service oriented and 5 are mixed, all towards consumption. We are seeing very good growth in these sectors, and at this point in time, we don't see any reason why we should add. But in case there is some opportunity which comes in where we see a lot of potential, theoretically we are open, But at this point in time, we would like to focus on these 8 sectors and keep building our expertise.
Okay. And secondly, on the commitment of the private equity players, so is there any outlook of the private equity players to stay with the company?
So, sir, any investor, whether it is a private equity player or a public market investor, have the flexibility and freedom to come and go, right? And that is the way we would like it to be. So like in an HDFC or ICICI or large platform, investors come and go. The platform or the institution should stand on its own. Having said that, we started with 4 private equity investors, of which 3 of them continue to sit on our board, and we are still within their investment cycle, and there is a long residual fund life. So we so that when it will be near to their fund life cycle, they will gradually divest, but that is not happening today.
Okay,
and
let
me add this. I know sometimes I've seen sell-side analysts asking this question, that what would happen when these large investors would sell. See, I've taken the case example of say AU or few other large NBFCs. Institutional ownership through private equity is very common now. But normally these ownership don't come into the public market. So there are larger financial institutions which would like to come and take over some of these shareholdings. So today we have 4 Asia private equity funds in our business, but there are then large funds, sovereigns, and others, both active and passive. As we continue to grow in size, they like to they would like to participate in platform like ours.
Okay. My other question is on the GNP and NNPA ratio. If not for this fast AUM growth, what could have been a GNPA ratio and NNPA ratio?
So I'll take that. So basically you are referring to our static pool delinquencies by vintage. And we keep monitoring that. They wouldn't have been too different. So the post-pandemic sourcing, post-July 2021, when we implemented our new GRO score 2.0, which took into account both the banking behavior and repayment behavior by sector, we are seeing that even after 12 months, 18 months, the book quality remains consistent. So it wouldn't have been too different.
Okay. Thank you, sir.
Thank you. A reminder to our participants, if you wish to ask a question, you may enter star and 1. Our next question is from the line of Nirvana Laha, an individual investor. Please go ahead.
Yeah, hi. Thanks for the opportunity. So the first is a bookkeeping question. So for the 9 months of FY23, I can see that the total comprehensive income is about 25.4 crores. But the equity from March 22 on the books to now has only increased by 2 crores. So how are we accounting for this?
I will take this. Your question is right that while our profit has increased, it is not reflecting into our total equity, because if you remember last quarter we have done set up an ESOP trust where we have purchased share of worth rupees 25 crore, which was adjusted with the capital. Hence, with this adjustment, it is what it is.
Okay, and is this trend likely to continue? So when will we see the book value increasing through profits flowing through to it?
So, sir, if you look at our public... Sorry, Kishore. In our public disclosure, the ESOP trust approval is for roughly around 28 odd crore, of which 25 crore has been exhausted. So rest of it will get exhausted as and when the trust decides. That's independent of us. But we should see now, with every passing quarter, we should see accretion on the net worth of the company.
Okay, thanks. So the next question is regarding the deferred tax assets. So Mr. Kishore, you said that 17 crores was still left from that demerger. Can you tell us what percentage of the 17 crore is likely to lapse again and hit the PBT? Because this number is affecting our ROEs clearly. So a clear guidance on that would help us model things.
So, as we move forward, depending upon the profitability, whether we will be able to absorb it or not will depend upon what kind of profitability we will have in future. But clearly, we can foresee that next year our deferred tax liability, which is about to lapse, is close to 7 crore. In our belief, with the profitability target which we have in mind, we should be able to absorb that. So there should not be any impact on PAT next year on this line. And then there is another line, another deferred tax asset which is there, which is roughly around 2.3 crore, which will be lapsing sometime 2029-30. So that much will not impact. Unlikely to impact, because by that time our profit will be very high and probably we will be able to absorb it next year or the year after. There is one portion left which is available, which will be lapsing this year itself. Part of the provision we have done in this quarter, and the balance portion we will be, if the profitability we are not able to absorb in next quarter, then that part we will be taking in the next quarter.
And how much is that, may I know?
I will have to check and get back on the same.
Okay, I'll connect offline on that. Secondly, on your projections for FY25, you have given two ratios this time, which is PBT by average total assets and PAT by average total assets. So if I look at the PAT to PBT ratio there, it's coming to around 18%. 4.5% divided by 5.5%. That's around 82%. So does that mean the normalized tax rate for UGRO going forward is going to be in that 18-20% range? Or are you factoring in some deferred tax assets reducing the effective tax rate?
So it will depend on two factors. One, that as I explained earlier, that we are into MAT as of now. So whatever provisioning we are doing, it is on account of deferred tax. Going forward, if the profits are there and we are able to absorb the MAT credit which is available, depending upon these factors, the final tax rate would arrive at that point of time.
So, as an outside investor, I should go ahead with 25% as the effective tax rate?
Not exactly, because again, MAT credit is available, so it will be available for utilization in 24-25.
Okay, I'll connect with you offline on this, Mr. Kishore. Thank you. I have a few questions on collection efficiency. So, the same month collection efficiency this time is around 94%, and it's consistently at that level. So I was just comparing the collection efficiency with banks. I know Mr. Nath has earlier said that this may not be the right way to look at MSME collection efficiency, but still wanted to just get a confirmation that the 6% that is flowing into buckets, how will this resolve into NPAs? I know that this was explained in the last call, but 6% optically when I benchmark with banks, which may not be the right benchmark, hence I'm asking for this guidance, it looks like it would translate into higher than 1-2% NPAs. But if that is not the case for our kind of lending, I would just like you to explain that, please.
So I use the big time. That's why we have two data. One is the collection efficiency, which is demand and total collection. So if you look at total collection, it is 97.5%.
Sorry to interrupt. Mr. Nath, your voice is kind of breaking up, so could you please repeat the last few sentences?
Sure. So I was answering this question that our 94% collection efficiency, what you are comparing with the bank is ours is 98%, right? So total collection, which is including overdue versus and plus current month demand, is the way most of the NBFCs and banks report. That is at 98%. Now, Anuj, can you take this 94% and what happens to the 6%? And but is that the right way to think that the 6% is all flowing into NPA? That's not the case.
Yeah, I'll take that. Thanks, Sachin. So typically, collection efficiency numbers should be seen in conjunction with the subsequent bucket resolution numbers. So when a account bounces the check for the first time, it moves to what in industry is called bucket X, and the bucket X resolution rate is the primary driver along with collection efficiency on what would flow further. Typically in our case, because it's a small business lending, the bucket X solution rates are closer to 98-99%. And hence, whatever is flowing forward is close to 1 and 1.5% only, which will eventually can become NPA. So a collection efficiency number along with the bucket X resolution number will normally give the full picture.
Okay, thanks for explaining that. On the co-origination book, so what is the percentage of FLDG that we usually have to provide?
So it varies, right from 3% to 7.5% is the first loss cover on co-origination with other large NBFC we have provided for. But the losses would be similar to what is on our balance sheet. So I think so. Whatever you are seeing is our credit cost is the total credit cost, which is right now is we are presuming 1.5%.
I see. And this is only applicable for when there's an NBFC on the other side of the transaction, not when a bank is there.
Banks are not allowed to take FLDG as per RBI circulars.
Okay. And could you tell me, out of the 74 crore total provisions, how much of it would be towards covering the FLDG guarantees?
Very, very small. Anuj, do you have that number?
So the provision is, the way we provision is the way if the co-origination business would also have been booked on our own book. So there is no difference. It is just that we cover it adequately by the way we do it in stage 1, stage 2, stage 3. So at this point of time, the coverage would be in line with that product. Typically, our stage 1 provision for unsecured loan is close to 1.5%. For a secured loan, it would be around 1%.
Okay. So the reason I was asking was today the provision is 1.5% of on-book AUM. So after removing that number, I just wanted to check what the provision to AUM ratio would come at. But I can write to you offline and get that number. So
yeah. So I think our provision includes the book which is co-originated book. So if I have 100 rupees of book of on balance sheet and 100 rupees book on co-originated, we presume as if we have 200 rupees of total book. And when we provision at stage 1, stage 2, stage 3 on the total of 200.
Mr. Laha, I'm sorry to interrupt. May we request you to return to the queue? There are several participants waiting for their turn, sir.
Sure.
Thank you. We request participants to please limit their questions to 2 per party. Time permitting, you may come back in the queue for a follow-up question. Our next question is from the line of Tushar Malhotra, an individual investor. Please go ahead. Mr. Malhotra, could you please unmute your audio and go ahead with your question? There seems to be no response from this line. We will therefore move to our next question. That's from the line of Joel Elias, an individual investor. Please go ahead.
Hello. Hi. Congratulations on the numbers again. I just had a couple of questions regarding the customer journey. So do we have any KPIs for evaluating customer stickiness, customer satisfaction, and customer retention? I wanted to know if we are aggressive with trying to get customers to be customers to borrow repeatedly. As in, what is our approach towards customers, and how do we evaluate that?
So we are still, as I said, my opening remarks are toddlers in this business. Today, as you know, we have multiple channels, and these channels, depending upon the need of the customer through multiple sources, are originating these customers for their multiple credit needs. There are a few things which we focus upon. One, turnaround time. Second, meeting the credit demand subject to the credit approval process. And third, post-disbursement experience, which is in terms of timely providing all of what they wanted to do that. Now, customers, so that is the count. We don't do formal customer satisfaction survey. We have done a very large impact study, which is published on our website, and it has also multiple testimonials of what kind of impact we have created for every segment of the market. And if you read through that, it will be very interesting insight, in terms of very large base of 38,000 customers, what we have been able to achieve. With respect to one aspect of further credit need, or for example, a customer which has taken a loan against machinery from us, whether we have approached the customer, whether he has come back to us for taking a secured loan, that has not yet started, because In terms of our installed capacity versus what we can service, there is still a gap. But now this year we are gradually progressing on that as well. Meaning we should be able to cross-sell multiple other things which a customer needs. So it's an evolution, and we are on that evolution progressively.
Got it. Thank you so much. That's it from me.
Thank you. We'll take our next question from the line of Tulsi Badrinath, an individual investor. Please go ahead.
Good afternoon and congratulations on your excellent results. I'm curious about the experience at the branch. Out of the current branches, say about 100, how many have broken even, and when do you expect the remaining to turn profitable? Also, are you planning on expanding?
So, sir, we have, of the 100 branches, we have roughly around 25 branches, which we call the main 25 cities in the country. We service what we call the prime customer segment. Those branches, given the size at which they operate and the little higher ticket size with lower yield, most of them are broke even very quickly. So, except I think so 5 or 6, which will be recent addition in this year, most of them are broken even. The micro enterprises, that's much harder business to build. Because these are tier 2, tier 3 towns, and these are direct originated business, so you have sales, credit, collection, legal, all of that. And then you have to have an origination strategy. You have to also build a brand, because remember, we do secured loans. So it says person who is taking a 10 lakh rupees of loan, but giving the papers of a 20 lakh rupees worth of his property, which is his only property, right? So there is a brand establishment and recognition has to happen. There we have roughly around 35 plus branches out of the pool of 71. And that's what I was saying, that with every passing quarter, you will have a block of 15, 20 branches who now would keep breaking even, and then they will have a positive cash flow coming to the company. So this is where we are right now.
Thank you. And my second question relates to growth score. I was just curious whether, when you conceived of it between the concept and what the data actually shows you in practice, have there been some surprises, positive surprises?
Anuj, you can take that, but I think so this time we have moved it to our annexures. So on the slide 37 of our presentation, you can still see the analysis and, of our growth score and how are they in line with expectation or not. We would say that they are in line with our expectation, but Anuj, you want to add something?
Yeah. So, if you recall, our growth score classifies the customer by risk band from A to E. And what we do continuously on quarter is to look at the performance not only of our own customers, but the customers whom we have scored but not disbursed, on how they are performing on other loans which they have taken from other financiers. And so far we find that the risk classification is stacking up quite decently, so no surprises. Although the data is still for the kind of comprehensive work which we have done, we would like to wait a little more, 2-3 quarters more, to see in case there is something else which comes in. But all the early indicators are indicating that the hypothesis of the growth score classification will stand good.
And this is also with growth score 3?
No, this is growth score 2.0. Growth score 3 is what we have just piloted. That will take into account GST as well, in addition to the repayment behavior from bureau and the banking behavior. So that we are going live in this quarter.
Okay. Thank you.
Thank you. We'll take our next question from the line of Akash Jain from Ascon Global Services. Please go ahead.
Sir, my question is regarding cost to income ratio. Say for in the presentation it is mentioned like for FY20 projection is around 45%. So for to reach the AUM size of around 20,000 crore, and how will we reduce the cost to income ratio? Like what expenses will go off, or?
So nothing would go off. Only your income side would keep going up. So you have pre-invested into a physical, technological data analytics infrastructure, and your incremental cost increase in terms of the OPEX versus your multiplier on the AUM and asset side would keep bringing down your cost to income ratio.
Okay. And since we are very strong on the technology front, so is there any plan to develop a special app like SBI's YONO app, similar to that kind of app for digital onboarding of customers?
So watch this space. I think so mid-February you'll see it.
Okay. Okay. Thank you, sir.
Thank you. A reminder to our participants, if you wish to ask a question, you may enter star and one. We'll take our next question. That's from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
No, we are growing.
I'm sorry, Mr. Iyer, you'll have to repeat your question. We couldn't hear you.
Yeah, hold on.
Could you ask your question, sir?
Hello.
Yes, Mr. Iyer.
Yeah. Okay. Hello, sir. Yeah. So I just wanted to know, we are our disbursements side is growing around like 11, 12, 13%. So can we expect the rate to be maintained at this, around 11 to 12% quarterly CAGR for like at least 1, 2 or 3 quarters going ahead?
Sir, as I said, our disbursements are not a function that we are lowering the yield for the customer. Our disbursements are a function of our capacity, which we have built over last, 8 quarters actually, right? So I don't think so that there is any decrease in our portfolio yield which will happen. In fact, we are now working as we see the higher yielding portfolios, micro enterprises, machinery business, and few others. We think that there will be few basis points, at least some increase which will happen on the yield. So I said this, that our OPEX to income ratio or our bottom line would increase by virtue of 3 things. Portfolio, the size of the business growing, a little bit of increase in our yields, and OPEX remaining flat. And we, in spite of probably borrowing costs going a little higher, we still think so that our profitability would keep going up from where we are.
Oh, okay. Right. Got it. That's all from my side. Thank you. All the best.
Thank you. We'll take our next question from the line of Sai Kiran Pulavarti from Pulavarti Advisors. Please go ahead.
Yeah, hi, sir. Thanks for taking my question. Just one quick question. You have got a very interesting slide.
Mr. Pulavarti, I'm sorry to interrupt, sir. If you're on a hands-free mode, can you switch to handset and speak, please? We can't hear you clearly.
I am on normal.
Okay, this is better. Yeah, go ahead.
Yeah. We could hear you. You are talking about an interesting slide. Yes.
Yeah. So there is a slide which explains the business model of lending as a service, where you have explained the ROEs and the ROEs, which will be far higher than normal on-balance sheet model. I do understand that you are already having certain off-book kind of an model which you are doing it. What could be the journey from the current level probably to a co-lending model where we will see the ROEs and the ROEs expanding meaningfully? At what scale or what are the milestones as investors we should track? If you can just help us explain, that will be really helpful.
So I think so we have given in our presentation. We have been giving this for a quite a bit of period of time. So if I may request you to look at the slide 20. And our slide 20 actually, in fact, we were thinking of taking off this slide because we said that we have already explained this. So in our slide 20, you'll see that we have said that by FY25, the return on asset should go up to 4.5%, and ROEs would go up to 17-18%. And with that, off book to on book at roughly around 50%. Now this is dynamic. When we say an off book AUM, this off book AUM have multiple components: the co-lending, the direct assignment, the co-origination, so on and so forth. But the broader point is, between traditional high leverage is not possible for non-banks. It's a very difficult task. If that is the constraining factor, then with low leverage to generate high return, you have to build a semi-marketplace model, which is an off-book model. And we are a market leader, and we'll see how it evolves.
Got it, sir. Great. Thanks, sir. That's what I thought. Thanks, sir.
Thank you. Our next question is from the line of Rishi a retail investor. Please go ahead. Rishi, could you please unmute your line? Yeah.
Yes, I'm audible.
Yes, you are, sir.
Yes. Congratulations on a good set of numbers. Now, I think a couple of questions that I had have already been answered with regards to what you saw the business as being different from 5-star finance and also on the gestation period of our investors who've been with us for 4 years already. So I think you've answered these questions. I just have one further question on what your official communication on the rating agency process would be. I think there was a recent downgrade, and I did read the announcement from UGRO, but it'd be good to hear from you on this call as well.
Exactly same thing, sir, which we have written. So we have not minced our words when it comes to what we have disclosed. So in 2019, we were signing a co-lending agreement with the State Bank of India. At that time, we had neither a requirement of any debt nor we have that much of asset book, and that rating was required to be taken urgently, and we went to Equity and they gave us the rating. And we signed our first co-origination agreement with the State Bank of India. We didn't realize at that point of time, because at that time Equity which was earlier called Samera, owned by SIDBI and large number of financial institutions. This is also the same period of time where rest of the rating agencies were deeply affected by IL&FS and DHFL crisis. So they were not doing fresh rating of fresh NBFCs. Whether it was ICRA, whether it was CARE, India Rating, all of them were deeply affected by the IL&FS crisis. So when we took Equity rating, we didn't understand the challenge with a rating agency like Equity. We have been raising this concern for a very long period of time with Equity that market acceptance of Equity is very poor. To an extent, a large private sector bank on whose board there is the chairman of Equity is there, but still that large private sector bank don't accept Equity rating. So, and also there is this market, benchmarking. If you are rated by used to be rated by Brickwork, Informatics and Equity, other rating agencies, rate you 1 or 2 notch lower than those rating agencies, because these Equity and likes of rating agency are not considered in terms of quality at par with the other rating agencies. Equity actually, in order to continue holding on to our business, upgraded us. First they made us, a stable outlook. Then they upgraded us, I think so, in August from A to A+. But in spite of that, we decided that we have to transition rating to larger rating agency and went ahead and took CRISIL as a rating agency. CRISIL, in all their judgment, rated us A-, which was 2 notch below what Equity had rated us. Now that is not in our control, but I think so Equity came under severe pressure because, regulators nowadays look at it very seriously, and each of the rating agency has to go and explain why their rating is too different from the other rating. And that's why when that happened, they had raised this concern that why we had gone and accepted CRISIL at a 2 notch below. We told them that, look, we can't survive with the size and scale of our operation. We cannot survive. And that's why we have taken other rating agency. And in order to self-justify themselves for a very flimsy ground, which actually, if you read our letter, all of their grounds are infructuous and they have no meaning, they decided to bring it down from A+ to A. We are transitioning Equity out. None of our lenders, both the term lenders or any other lender, have raised a single point of concern with their rating downgrade. Hopefully this is very clear.
No, that's very, very clear. And thanks a lot for the transparency as well. And just one further question. I mean, with the funding winter that we are seeing for startups and other tech platforms in India, do you see any issues with the fintech that you are associated with on the UGRO Xstream platform? Do you see any less participation from them in the recent past, or?
Sorry, I didn't get your question. Your question is, are we investing into those platforms? Is that the question?
No. The users of our UGRO Xstream platform, where you are doing co-lending with other fintechs like Kinara Capital, etc. Do you see them participating less on the UGRO Xstream platform these days, or are the participation still?
No, I think so, sir. Actually, the opportunity set for that is much larger and much wider. Because our self-origination channel, we technically stop at the yield band of, or a customer band or a risk band of what we call the 18 to 19%. There is a large set of customer population which starts at 18-19% band and go all the way to 30-35% band. We don't do that on our own. But obviously there are large number of credible platforms. It can be a fintech, it can be a small NBFC, it can be a revenue-based financing or any form of innovator which is backed by good capital and have ability to absorb losses and is willing to work with us. So actually the number of partnership or integration has gone to almost 79. However, we have been holding on to not growing that book, quite rapidly. So on an average, we are doing 50 crore a month, and we have been diversifying the base of our partners. We are evaluating and seeing that should we increase this, given that now we have 2 years of experience, we understand each partners and we have seen their vintage. So I think the beginning of the next financial year, we take that call that whether we maintain this at the same rate where we are or we accelerate it given the number of partners have grown.
Okay, understood. I have one last question. I don't know if I can squeeze it or I can get back in.
Please go ahead, no problem.
So, this question is, I've been listening to interviews from Five-Star Finance, and one of the things that they said as their moat is the non-competitive nature of Tier 4, Tier 5, Tier 6, and that's why they believe that they are worthy of a much higher valuation than other peers. I was wondering as to how would you see this, like given that UGRO is not really in Tier 4, Tier 5, Tier 6. I don't even know what Tier 6 is, to be honest, but what is, according to you, a good geographical speak for UGRO? How deep would you penetrate in the future?
So I would refrain from commenting of what another player talk about their business and what their moat is. That is for the market to judge. I think that we have at the beginning of our micro enterprises channel, we think that the real credit need is for the micro enterprises. The micro enterprises which exist in Tier 2 and Tier 3 town. And as you rightly said, I don't understand what is a Tier 6 town. From my experience, coming from a very small town city, that is largely a tehsil or a taluka. Very difficult for that to have a business, franchise where you can go and do too much of credit. But Tier 2, Tier 3 town are good enough. And as per our last evaluation, we looked at the entire India, and our analysis, tells us that the 5 or 7 states, from a credit behavior perspective, are the best states, and roughly around 350 pin code locations where the cluster behavior of the credit is very good. So we would like to go in those 5 to 7 states and in those 350 to 400 plus cluster locations.
Thank you very much for your patience.
Thank you. We take a last question from the line of Nirvana Laha, individual investor. Please go ahead.
Yeah, thanks so much for the second opportunity. So, Mr. Nath, my question is on the lending as a service slide. So I see that earlier we used to have 6 banks and 6 NBFCs as partners. This quarter it has come down to 4 NBFCs. And we used to show a pipeline of potential deals that I don't see this quarter. So my question is, to reach our 10,000 crore off book target for FY25, how are we placed in terms of these existing 10 partners, and how much do we need to depend on forging new partnerships?
So, sir, why it has come down? Because we have learned the art of saying no. Because when we started, we thought that actually, we are a small company, we are a young company, and, anyone who is showing interest, we should do all effort and just go and sign up. We realized that in marriages, it is not just important for bride and groom to come together and tie the knot. They have to live together also. And living together had different connotation. Even if you have been a boyfriend, if you have been partners and known each other for a long period of time, once you start living in the same room, it's a different story altogether. So in view of that, certain, not the bank, but certain NBFC which we signed up, but we don't think so that philosophically our philosophies match. So we have suspended those partnerships very amicably, and we'll go back to them. In terms of why the new lines are not there, because the existing capacity we are not being able to service. the top 3 banks, public sector banks in India, the number which you are quoting up to 2025, 75% of that actually is among the first 3 banks which we have signed up, right? And we have not been able to deliver that at all. So that's why we were under so much of pressure from existing large banks, each one of them having expectation that we will deliver 100 crore per month. We thought that we should limit our relationship right now and expand only next year. When, so one bank has now reached up to, I think, 700 odd crore. Other bank has reached around 200 odd crore. So I think 1,000 crore to 1,500 crore, wherein a large bank would pause and review us and then give us another 1,000 crore of line. So I think we have more than sufficient partnership which exists today, and at our choice we can increase it whenever we want.
This is wonderful to hear, Mr. Nath. And as an investor, if I may request not to remove slide number 20, because every time we see the FY25 figures, the aspirational figures, it reinforces the fact that that's what management is aiming for, and that's why they're invested. So a small request from my side.
We will keep doing that. We expected that, by giving that slide, people will not look at us from last 2 years perspective on 2 years. They will focus on what we are going to deliver in next 2 years, and they will correlate with quarter-on-quarter performance. We were not seeing any good result of that. That's why, being disheartened, we were thinking of removing it, but we'll take your input and not do that.
Thank you so much. And we as investors are really excited for this journey. So wish you all the very best.
Thank you.
Thank you. I now request Mr. Sachin Nath to add a few closing comments. Over to you, sir.
Thank you very much for listening to us patiently and asking, very good questions. Obviously, every time you come on the quarterly call and when we hear each one of you, it motivates us to keep doing what we are doing today. But even if you have further questions, Mr. Nirav Shah, our Head of Strategy and Investor Relations, and his very capable team would be happy to answer you any further questions which you might have. We'll see you next quarter at the end of the year. Thank you very much.
Thank you, members of the management. On behalf of UGRO Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.